Welcome to the State of the Treasury Profession message. I'm Kathy Gregg, and I'm a partner with Treasury Strategies, and I'm joined here in Chicago by Tony Carfang, who's also a partner at Treasury Strategies. And as well, we're all collectively joined with about 800 registered attendees for the webinar from 60 different countries. We're gathered here today to present our 10th annual look at what's in the cards for Treasury this coming year. A couple of little housekeeping things before we dive in. First, everybody who's registered for the webinar will receive the deck and a link to the recording within 48 hours. Also, the presentation will be up on our YouTube channel within 24 hours. Feel free to ask us questions by typing in the bottom right-hand corner of your screen, and we'll follow up with you on those. So for today, we have 3 topics for you. First, expecting the unexpected, which is some comments about the relentless change that is now our daily expectation in Treasury, and a few macro areas that should be in your broadening frame of reference. Second, we want to talk about the A-team. There's solid evidence that Treasury's fortunes are improving resource-wise, and we have some thoughts about leveraging that. And finally, complexity, a couple of specific topics where we think treasurers really need to get it right for this year. So a lot of times when we do this, we like to look back on what we've said the past couple of years, and we're a little bit egocentric, so we like to pat ourselves on the back for being right. And on the screen here, we have some of the things we've prognosticated recently. But the most important thing about all of these prognostications is that our clients and listeners have benefited from hearing about them and incorporating them. It really helped during the recovery to be able to see the upside in having the CEO suddenly learn where the Treasury offices were and show up in the doorway all the time instead of feeling like you were under a microscope when that happened. It also really helped to be able to see the upside in the expanding expectations of Treasury. For example, in the fact that now we needed to have 100% global, real-time visibility of all of our liquidity positions and risk versus the 80 or 85% that we used to be very, very happy with. And it also really helped to be able to keep progressing the Treasury agenda, despite the fact that at some points during that long, long recovery, we felt like we were trapped on an airplane with a bunch of screaming babies. So what do we see for Treasury in 2016? And in a nutshell, the answer is more. There's going to be more to confront in the markets, more volatility, more global impacts, believe it or not, more intrusion of regulation. Basically, nonstop challenges to the very important role Treasury has in helping your company grow and prosper. There's also going to be more functions for Treasury internally. Most of you say that you're getting a broader remit. More of you have responsibility for supply chain finance, for commodities, for insurance, these kind of activities in addition to Treasury. Treasury is going to be getting more resources. Yes, you heard me right about that. For years, the already lean Treasury staffs were again and again asked to cut, and the only mantra we had was do more with less. But that is changing. Recent research that we've completed shows that a significant number, more companies than ever, expect increases in their Treasury staffs in the coming years and have invested more money than ever in their Treasury technology, which is now far more seen as a necessity than a luxury. So we're going to have to change our thinking to doing more with more. So Tony, let's dive in and start talking about some of the more that we need to expect for this year.
Well, thank you, Kathy. And the theme. Thank you, Kathy. And the theme for 2016, I think, in addition to doing more with more, is to expect the unexpected. And if there's any question about that, you just look at the markets over the last 4 weeks, and every day is another unexpected event happening. There are more moving parts than ever before, more complexity that corporate treasury and the institutions that provide services to them must deal with. For example, the markets have fundamentally changed. The instruments that you use are changing. The institutions that provide you access to those instruments are changing. Spreads are widening because of certain regulations. Volatility is increasing for a number of reasons. Central bank interference in markets, widening spreads because of low dealer inventories. I mean, the list just goes on and on and on about how the markets have changed. In addition, the rules have changed. Money market fund regulations, which are being phased in different parts of the world, are changing the supply and demand of a number of securities. Basel III is changing the way banks have to manage their balance sheet and evaluate their customers. EMIR and the Volcker rule are impacting dealer inventories and spreads, and KYC and AML regulations are putting you under your bank's microscope like never before. And the consequences are still emerging. Many of the regulations, while the broad outlines are pretty clear, are still being implemented or still being phased in. We're still dealing with that, high school chemistry class experiment where you put a whole bunch of stuff together and see what's happening. Well, we're seeing smoke and bubbles and everything here, and the only thing we're certain about is that the result will be unexpected. Traditional service providers have refocused. Many of these regulations are requiring banks and other financial service providers to hold more capital, which reduces their rate of return, their return on equity. That means that some businesses that were marginally profitable before will not be profitable now, and some banks we've already seen are exiting certain geographies, certain product lines, certain types of customers. And the latest, you may have heard some central banks talking about requiring banks to maintain total loss absorbing capacity, or TLAC, TLAC as it's abbreviated, which is kind of an additional layer or buffer that banks have to maintain that will further depress returns and cause the banks to even more sharply refocus. New fintech players are emerging. Now, for the last several years, we've been hearing about fintech companies with all their cool mobile apps and all the clever things and convenient things and low-cost things that are happening. They're clearly disrupting, the traditional marketplace. Historically, these have been sort of retail kinds of applications, but we've now reached the point where corporate treasury must be well aware of what's happening in the fintech marketplace, because these are services and activities that you, through your treasury and through your business units, may want to be rolling out to your customers. This is all part of your payments ecosystem. And then finally, new tools are available to help corporate treasurers. The ERPs have become more sophisticated. Treasury management systems are now very comprehensive. They're able to accommodate more data and do more analytics. In addition to that, many of you are getting access to your company's big data repositories, which will allow you to actually be much more effective. Now, let's talk about some of these moving parts that are going to be challenges in 2016. You have divergence in interest rates. U.S. rates may be rising, while European rates in the other parts of the world are flat or falling. Volatile exchange rates, and we've already seen that quite a bit so far this year. Fallout from Basel III. Many of you have had conversations with your banks about the value of your deposits, the liquidity coverage ratio, and other things that are still coming down the pike, still being worked out, and these are things that you will have to deal with in 2016. Uneven economic growth kind of speaks for itself. Commodity price challenges, this is actually a double hit in 2016. Price levels obviously impact your supply chain. you may need to do some hedging or at least planning for some challenges in this area, but the other hit, the second barrel here is that particularly in commodity-based jurisdictions or regions of the world, the currencies themselves will be impacted and the exchange rates by the value of the underlying commodities in those countries. So this is actually more complex than it sounds on the surface. Corporate tax rate imbalances around the world, which is leading to pockets of trapped cash. And then scattered pockets of illiquidity. Again, with lower dealer inventories, wider spreads, and thinner markets, basically with central banks crowding out the private sector, we're seeing gaps emerge, even a flash crash not too long ago in U.S. Treasury market. We've seen gaps in municipal markets. In fact, on our YouTube channel, the Treasury Strategies YouTube channel, there's a great video on collateral scarcity. You may want to just go into YouTube, type in Treasury Strategies, and our channel will come up around the top. You'll see a full library there. Now, in addition to all this, your service providers are in flux, and it's important that you not be blindsided here and get that unexpected call that says you are no longer in our target market. That would be a disaster. But banks are more precisely targeting their clients to meet the regulatory demands that governments around the world are placing on banks. In addition, traditional technology companies are offering more robust solutions and may play a different role in your Treasury ecosystem. And then finally, fintech companies are reinventing ways in which you will interface with your customers. A couple of interesting engagements we're doing at Treasury Strategies is helping a couple of our clients figure out how to use payments to build customer loyalty, to interface better with their clients, and to make the transaction more seamless, basically using payments as a business development tool. So a lot of things going on. Expect the unexpected in 2016, and Kathy will now give you some ideas on how to cope with the unexpected. And one of the main parts of doing that is the team that you put together to handle all of this, the A team. So many of you will be getting more resources. And even if that's not you in 2016, we all need to be thinking about putting together the winning team. Some characteristics of that team include, first of all, the winning team is obviously a quality team. There is simply no percentage in just trying to get by anymore. You might as well think like a winner and try and build the winning team. This winning team, think about it, it's broader than just the people that report to you in Treasury. It's broader than employees of your company. It should include internal and external partners. And to some degree, it's worthwhile also to think about the tools that you have as part of your team, as part of executing your mission. And of course, this perspective of the winning team is not interim or short-term at all. It's a long-term concept. It may take you a while to assemble all of the right players that you need here and the right parts, but it's going to be worth it. And let me just mention that having a compelling strategy for what your Treasury is about, what you're focused on, what you want to accomplish, that's going to help you attract a compelling team because people will be able to rally around that. So let's talk about these components first, the internal people, the external people, and the technology. We mentioned earlier that treasuries are getting more staff, and that's true. You need to make the most of your hires. And we suggest, this might be a little bit counterintuitive, but we suggest that rather than building your organization around the people you currently have on your staff, that instead you stop and design the Treasury organization of the future for your firm. Determine what talent that requires, see how your current team fits into that,
and have your plans over time for filling in the missing gaps as you go along. This approach will probably make it clear to you that it's now becoming less important to have people whose main skill is execution, and more important to have the thinkers and the visionaries. Also, you absolutely don't want to neglect building your connections elsewhere in the firm. There are more and more people who are part of the good solution here. They could be people in IT. They could be marketing people. Tony was talking quite a bit about the increasingly important role of payments in building customer loyalty and part of your value proposition as a firm. A lot of that may come through the marketing group. It could be the compliance and security people. I mean, there could be people all over the firm that are important, and having real allies in these areas is going to be huge. Let's also not overlook that there is an increasing cost to just being average in this business. You need to go for talent and vision because there is this cost. There's a real cost to having one of your banks say, you don't fit in our target market anymore. And if you didn't know that was coming, if you hadn't been on top of that enough, that would be not a happy surprise. There's a real cost to being caught in a liquidity gap or an illiquidity gap. Obviously, having a bad forecast and having to sell something at a loss to meet your liquidity needs, not a position you want to be in. A very real cost to not having visibility of a currency that's truly volatile and important to your firm. All kinds of more important costs, and being average simply isn't going to equip you to deal with that. And last, I just want to make note of this point. Spend some time thinking about what competencies are really valuable for your firm in the particular lines of business that you're in and the types of customers you deal with. Is your firm likely to be into these new payment types? Maybe you're already into those new payment types. If you're doing business with consumers, are you selling on the web, and what does that require? Point of sale changes, what does that require? Card payments, are those important to you? Is PCI driving you nuts? If you're not so much of a B2C kind of business, if you're more B2B, are your regular mergers and acquisitions constantly moving you into new parts of the globe, new currencies, new geographies? And what kind of talent do you need to support an agenda like that? Okay, so turning to the external partners, and this is perhaps the least intuitive part of your A team. We think of your external partners, they could certainly be your bankers, and they probably are. But it's also broader than that. You could have people from payments companies, from some of these fintech companies that end up on your external partner list. It could be risk advisors. Could be people like Treasury Strategies. A wide net of external players to be considered. And I am not suggesting that everybody you deal with externally needs to be on your A team, but rather that you think very selectively here. You're looking for the real A players in this broad group of people, the true cream of the crop here. People who can really contribute ideas and expertise and think for the future. People who are willing to do this. Not everybody is willing to invest in their customers. Right? You need people who are willing to invest over time with you. And people who have a relationship mentality versus a deal mentality. There are a lot of players who look to do the deal and then move on. And that's not what you're looking for here. You want somebody that has a longer-term vision of their relationship with you and sees value in that. And then the flip side of that is you need to be willing to share your vision with your external players so these A-team guys and gals can surface. You need to have a relationship mentality instead of a deal mentality. This is if somebody's going to invest in your company like this, be a partner with you like this, there needs to be some level of compensation for that value that is relationship-oriented versus deal-oriented. You're not going to identify these people in a Mickey Mouse RFP process that is totally driven by procurement, who is simply trying to flog every last penny out of the deal and restricts access to you. That's not where these kind of resources are going to surface. And finally, the non-person part of your A-team is your technology. More firms than ever have invested more money than ever in their Treasury technology, and it's not just a Treasury workstation anymore. It's your ERP connected to your TMS, connected to SWIFT, connected to your banking systems. It's your recon software. It's your risk management software. It's your transaction execution systems, your payment technologies, your payment platforms. It's a much broader view, and it's terribly important to the mission. And everyone, virtually everyone, has dissatisfaction with their technology. There is not a company around that will sit there and tell you, yep, we're 100% across all things. The needs are pretty consistent. Lack of integration. My platforms don't speak to each other. Missing functionality. You know, we just never got that risk platform up and running the way it should have been. We're behind in our upgrades, and there's things that the vendor has put in that we need, but we haven't had time to get to it. And so many people talk about they've made the investment, they love their software, but the reports that they get just don't do the job. This is your biggest investment that you make in Treasury. You need to get the value that's in there. You need to get the value that you paid for. So you've got to be about the business of plugging these holes. And the good news here is it normally doesn't mean you have to rip and replace. You don't have to go back to ground zero and start over. You can add a module or a bolt-on, which is a whole lot easier than rip and replace. You can finish the piece of the implementation that you never got around to 3 years ago. You can do the upgrade. And you can get a report writer in to create the reports that you need to get the value out of this. This is the equipment that you need for the financial market complexity that we're going to talk about.
So we have the A-team, or we're working on building the A-team, and that A-team is going to be dealing with a lot more market complexity. One of the first things the A-team needs to do is to re-equip Treasury to deal with new interest rate dynamics. You know, we have rising interest rates in the U.S., we have negative interest rates in Europe, we have diverging paths across the world, and frankly, it's been 8 years since your Treasury team has really had to deal with interest rate complexity, and in many cases, the people who dealt with that are no longer in Treasury. You need to re-equip the team. You know, will the U.S. continue to tighten? You know, your job in corporate treasury is not to try to outguess the central banks, not try to guess what they will do, because frankly that's not possible, as we've all learned to our peril at one time or another, I'm sure. But your job is to plan for the reasonable scenarios and have action plans in place should those scenarios come to pass. That's what you must do. You will not guess the central banks, but you can plan for a wide range of scenarios. One thing to keep in mind, you know, last month the U.S. Federal Reserve raised interest rates for the first time in years and years and years. If you look back historically, you will find that there have been, on average, 16 rate hikes before the next interest rate cut. So think about that. And, you know, having lived through a few of those, I can tell you that the first rate hike was going to be, you know, just a temporary thing, and we were going to see how it goes, and, you know, it's not a big deal. And then it was followed by 16 more, and everybody's crushed. Your A-team must decide whether to invest long or short. Whether to borrow long or short, and in which currencies. And to do that, you know, as Kathy talked about teching up, you know, your modeling, your analytics, your ability to simulate your company's balance sheet, your company's income statement through a number of different scenarios helps you answer these questions. To hedge or not to hedge? because of Volcker, EMIR, and some other things, counterparty clearing and collateral requirements, this is not as straightforward as it used to be. The cost of hedging has gone up quite a bit for most, all except for the very largest companies. And so it's not obvious that you should hedge. And then finally, are there natural hedges that you might be able to find elsewhere in your company? And again, it takes analytics, it takes brains, it takes the A team to do that. Now, the next part of managing complexity is to make sure you have sufficient liquidity. The job of corporate treasury, first and foremost, is to have sufficient liquidity to pay today's bills today. If you can't pay today's bills today, you are bankrupt, you are out of business. So liquidity is the lifeblood. You need to maintain your access to cash, and for those of you who tune into Treasury Strategies quarterly cash briefings, you already know that companies are continuing to increase cash around the world. And as a matter of fact, the trend line, the regressions that we showed in our cash briefings show no let-up whatsoever. That tells us the corporate treasurers are concerned about the ability of the marketplace to meet their capital needs. New money market fund regulations may actually reduce the supply of prime funds, which actually reduces then assets that money funds have to invest in corporate securities. You need to avoid liquidity gaps in the marketplace, in the financial markets. You need to be vigilant so that should there be a freezing up or a seizing in a marketplace, you have already planned workarounds. You've created action plans for those scenarios. Kathy spoke about maintaining 100% visibility of your cash and your risks. I'd like to add a point about auction rate securities. Many of you on the line remember that these were the panacea. It's kind of like issuing a 30-year bond. The resets every week. Every week there's an auction. So in fact, you're paying short-term rates for long-term debt. And that was really fantastic until one day in February of 2008, the auctions failed and those securities froze, and several $100 billion actually became illiquid overnight, totally unexpected. Now, on top of all this complexity, we have central banks around the world still ballooning their balance sheets, frankly, and the public sector is crowding out the private sector. So, maintaining liquidity is really essential here, and that moves into also securing access for long-term capital. Given the changes in the banking system and the changes in the public markets, access to capital is something that you used to take for granted, but can no more. The relationships between our corporate clients and their financial institutions has changed. Regulation has forced this. Economics has forced this. The relationships are much more transactional, much more compliance-oriented, less relationship-oriented. Our clients tell us that they have great relationships with their bankers, but not necessarily great relationships with their banks. That's a fundamental change. You have to be able to count on your bank, and if you can't count on your bank, you need backup plans. When I started in banking, they taught us 3 C's of credit: character, capacity, and collateral. And if a borrower had character, capacity, and collateral, you made the loan. By the way, you'd never make a loan to collateral that eats. They taught us that in credit school. What we're finding, though, is the character's kind of fallen out of the equation, and capacity and collateral, because of regulation, are really changing that dynamics. Relationship banking is moving now toward compliance or checklist banking. The last point I want to touch on is cash forecasting, because the opportunity cost of a bad forecast is beginning to soar. It impacts your rates, yield curve, your currencies, your exposures. Your ability to manage all of this comes down to a cash forecast. Many of our clients who say they have a good forecast, frankly, only have a cash calendar. They put in the knowns or the readily estimatable variables into a cash calendar, that is not sufficient for the complexity of 2016. Better variance analysis, tighter relationships with the business units. There hasn't been a high cost of bad forecasting for 8 years. You need to dust off that technology. You probably need to actually seriously upgrade that and think about your processes. Finally, I'd like to touch on the results of our State of the Treasury Profession survey. And our corporate clients actually ranked 34 different potential activities that could be priorities. And what's fascinating here is the top 10 of 2015, while the order has changed just slightly, are still the top 10 of 2016. They're pretty much the same. That could mean a couple things. It might mean that you didn't get to these things in 2015 like you had planned, in which case, call Treasury Strategies and we'll help you get that done. It may mean that some of these activities are actually of enduring importance, or they're in a state of constant flux, and you need to work on those and make continual improvements every year. We'll, by the way, send you an executive summary of our survey, and we thank the 350 of you who participated in that survey. So, with that message about complexity, Kathy, can you pull this all together for us?
So, Tony, for 2016, basically we're going to be doing more with more. There are more turmoil within the players that impact us in the Treasury space. The fintech players are starting to unsettle the banks. We've got new products and new payment types that Treasury actually has to get its head around. We've got more moving parts in the exchange rates, the commodity prices, the trapped cash, the illiquidity pockets. We have more thinking to do about putting together that A-team, more players on there, in particular the process of identifying the external players that can really contribute. And as you've just covered, more complexities to be dealing with. Let me just give our 15-second commercial here before we close with the tips for 2016. Think about Treasury Strategies as a potential external partner for your A-team. We can contribute a great deal to helping you get your strategy laid down, to planning the Treasury of the future, and many important tactical areas. So, now where to go with all of this? As you exit the call, before you dive back into that huge pile of stuff on your desk, just take a few minutes and write down 2 or 3 ideas or areas that you want to address for 2016 that occurred to you while you were listening here. And think about who can help you, the internal and external resources that can help you accomplish those ideas, and how to get those on your A-team. And if you want to discuss it with somebody, please give us a call. Most importantly, we look forward to helping you make 2016 the best year ever. Thank you so much for joining us today. We look forward to hearing from you.